Welcome to Getting Our Reward Heads Together, the podcast for reward and HR leaders brought to you by Reward Heads. We're a boutique consultancy creating bespoke solutions for our clients, but we'll tell you more about that after the episode. For now, let's get started. My name is Victoria Milford and I'm the CEO of Reward Heads. Today I'm joined by Richard Beeby, an experienced reward director in the tech sector in companies like Trustpilot, Essential, Funding Circle and Dentsu International. And we're talking about reward challenges in the tech sector.
Hi Victoria, great to be here. This is a really timely topic actually, because as tech employers, we're really dealing with three big pressures at the moment. So market rate pay, emerging roles and skills, and also finding that right balance of total reward.
Yeah, exactly. And tech's one of those sectors where the pace of change is relentless, isn't it? By the time you've benchmarked a role, the market may have already moved on.
Yeah, that's right. It's not just about setting competitive pay today. It's actually making sure the approach is flexible, just to keep up with the pace of change for tomorrow.
Well, let's start with that. Let's start with the market rate of pay. It feels like the biggest and the most immediate challenge. What are you seeing?
Yeah, the first challenge is keeping up. I mean, I've been in the sort of reward space for sort of 12, 15 years now. And, you used to have this real traditional, most employers do a 3% increase. And I think that's what a lot of people are doing for 2026 in the UK. But in tech, we're seeing real, large increases, based on role and skill set. Some roles that I've been looking at, is comparing like year-on-year data, I'm seeing move several times more than the actual average market. We did a pay band review recently, and some roles are about 4 times that UK average. Wow. But there's a real variation between roles. One that really stood out was sort of a mid-career machine learning role. That increased by about 10 times the UK average just year on year. I know. So we've got that kind of challenge as reward people. It's like, do we run a 2-tier or even a 3-tier salary review process and say, tech roles get this percent and non-tech roles get that? Or do we just prioritize internal equity cross-functionally and have that real consistent message around we're doing 3% as a company, but we lose our market competitive, real competitive nature there. Mm-hmm. But whatever way we do it, we do that 2-tier or 1-tier, we run that risk that new hires come in and they're just paid more, and that then creates more internal equity issues, or you hold it flat and you've got talent who expect to be paid market and we're just not paying it. So that whole sort of peanut butter, one size fits all pay review just doesn't work here. Yeah, I think it's hard to do that. If you treat all roles the same, so if you risk losing that critical talent where the market is really moving the fastest, and roles, anything with the word AI, those AI skills seem to be commanding real significant premiums. I think the pressure is going to get even more intense in that space. Yeah, it is a really difficult balancing act, isn't it? Because if you chase the market too aggressively, the cost compounds across pay, pension, bonus, and everything else linked to base salary. Yeah, and so you just need a real clear philosophy up front. You need something that your leadership teams especially, but the whole people team and especially your talent acquisition team all really need to understand what those pay principles are. And they each need to be able to really explain, what is it you're trying to protect? Is it internal equity? Is it your market competitiveness? Or is it a sensible balance of both? But when you chase the market, and we know this, the salary then gets baked in, it's compounding for your future increases, pension increases go up, bonuses can go up, and anything else that uses base pay. And then to worry about the comparisons then, not just sort of peers in, doing the same job or similar jobs, but also cross-functionally too. The equal pay legislation, the 2010 UK Equality Act, you look at the definition of light work and it's actually quite scary. It's like roles that require similar levels of skill, effort and responsibility, even if the work itself is completely different. I mean, I know case law is really complex, but where we've got things like that and those definitions are quite broad, correcting internal inequity is probably has to be done by the next pay review. And that's a principle that I've sort of stuck to. It's my material defence factor of market forces probably sort of washes away by the time the next pay decision is made. So, we just have to make sure we budget for that and reduce any risk of any equal pay claim. Yeah, that's a really interesting one. I'm hearing a bit about companies really looking at premiums, so market rate premiums or supplements, which does reduce the risk and increases that equal pay defence that you talked about. But I do sort of wonder how useful they are, because if they're removed and they're a significant part of someone's package, you've got other challenges to deal with at that time. Yeah, and because they're normally non-consolidated as well, so they don't really count for anything like mortgages or sort of rent applications. So I'd only really look at those if the wider industry that I was competing for talent does the same thing. Otherwise, we're just going to be an outlier and be really less competitive for talent. I was reading, just like looking at, where would you even set these premiums? I was reading a PwC study from 2024, and it said back then that AI specialist skills carried a 14% wage premium versus those that didn't. And then they published some data last year that's moved that number closer now to 23%.
Wow.
And globally, that was even higher. They analysed about 1 billion job ads worldwide and saw a 56% premium for those with AI skills.
Gosh, that's incredible, isn't it? That's really quite mind-boggling. And I think it ties into the second challenge that you highlighted, those sort of emerging roles and new skills. And that's where tech often gets ahead of the market, isn't it? Or the market data, at least.
Yeah, no, completely. And this has been a real recurring issue. You're trying to price jobs that don't really exist in salary surveys yet, or where the external data is already outdated. The role is real, the talent is scarce, the market moves faster than the benchmark cycle.
So what do you do when the data's just not there?
Yeah, I came across this about 12 years ago first, and I realized that I had to work with almost like a proxy data approach. So I was in a global marketing agency, and they asked me to price a programmatic buyer. I'd never even heard of it. I had no idea what that role is.
I don't think I still know what that is.
The guys that basically bid for cookies in real time and build algorithms. So as you log onto a website, you get an advert that's tailored to you.
Wow.
And it's an online auction, and they do that. I mean, and again, this was 2014. There's technology's moved on a lot since then. Yeah. But the only salary survey I had then was this year-old PDF that we'd bought from a big data provider. And of course, I looked at the data, and it might have had programmer, or it might have had a couple of other things, but nothing even remotely in line with this job. And I just knew the moment I got that survey out and showed it to one of the recruiters or the line managers, I'd lose all my credibility straight away. Mm-hmm. So that same problem, real role, scarce talent, data that's old, leadership teams want to make a hire, or they've got people internally saying, they're getting 20% uplifts and they need to match those salaries, otherwise the people are going to leave. And again, it goes back to that, the legislation lag matters here again. Equal pay moves at the speed of our courtrooms, which isn't that fast. Market rate for talent moves at the speed of computer viruses. They just run really quickly. And where to put these premiums, or how to work with this proxy data was more a case of, talent now probably has a cycle of about 5 years. When you think about the skills that people are learning in the tech space, probably 5-6 years ago, cyber was the big thing. Now it's AI. Probably 10 years ago, anything with the word digital in front of it attracted these big premiums, and they're commonplace now. But then you think about, the people that are at university now on a 4-year uni course, and those AI skills they learn in year one, they're obsolete even before they graduate.
That's terrifying when you're thinking about their student loans as well.
So the thing with this, and long story to get there, but I kind of have a look at where is this talent coming from? What's the comparable roles they've done before? What were they paid in those adjacent markets? And then decide, where do we want to match? Is it the hottest market, or set it slightly more as a generic base salary and offer more frequent reviews, more frequent outside the annual reviews? So it's kind of where are they coming from? What's the premium we want to apply to it? And then make decisions that way.
I like that. It's very pragmatic. It acknowledges that not every role can be priced neatly. That's not just in tech, right? That we see that across the board. And people do like to put people in boxes and go, well, that show me in the data the equivalent role. And you're right, it doesn't always exist. And you have to come up with something that sort of makes sense. If every role was in every survey, reward would be the easiest job in the world.
It would be. And it's, it's important across the board, and not just tech roles, as you say, but skills become obsolete really quickly, and there's so much sort of bleed of these skills. They're not just now traditional tech roles. I mean, people in people teams, for example, are now coding in AI or using SQL to do their job. So it's not just uniquely you're in the tech team, it's your problem. But these skills have got such short shelf lives before they do become common. Everybody, I think, is going to be using some form of AI in their jobs in the next couple of years. So, it's what's next. How are we going to go on and learn and deal with this change?
Yeah, for sure. Okay, so the third challenge that you mentioned at the beginning was about finding the right balance of total reward. Now, again, I think that's a challenge and a growing challenge for every employer, but not every sector can kind of put everything into their toolkit in the way that tech can. That's an opportunity, but it's also a challenge. So in tech, it's a bit of a fork in the road, isn't it? You've got cash, flexibility, benefits, bonus, equity.
Yeah, I mean, the wisdom is always that cash is king. It's visible, it's immediate. It matters a lot when employees feel financial pressure, but we need to be clear on the value of total reward. And I think you're right, it gives us more flexibility and real stronger long-term proposition if it's designed well.
So would you say cash still is king?
Yeah, I would. I think people prefer cash when they've got high personal costs, like rent or mortgages or student loans to pay, and they need to tick those down. But and if people come in for jobs, they know that their premium or their skills at these premiums. They know that AI commands this premium in the market. So cash is still king at that point. Offering the cash supplement that we talked about earlier, it's really easy to defend under equal pay law, and it's easy to turn off if the market cools. Cash has got so many pros, like certainty, it's transparent, it's really easy to compare against competitors, especially if they're competing offers on the table. But look, it's got its cons as well. We know there's a higher tax burden, in the UK, national insurance, both employer and employee, and income tax. We're starting to face a lot of people at this mid-level now starting to earn in that 100k mark, getting that UK 60% tax trap that we're starting to hear about. And cash lacks that stickiness. It doesn't really keep people long term.
Yeah, absolutely. And flexibility seems to matter more and more, doesn't it? Again, especially in this sector.
Yeah, it really does. And I think flexible working is not it's not a perk anymore, it's an expectation. And it's probably, I'd say, in tech companies, it's just as important as salary, especially for retention and attraction. Biggest flexible benefit now is definitely flexible working. It's shifted from a nice to have to probably just table stakes. There's a CIPD report I was reading recently that said 2 in 5 employees say it's a deal breaker when applying for a new job. And the tech sector, the same report said that 3 in 4 say it's as valuable as salary. And I was really surprised when I read on that said, that the CIPD report saying that 2/3 of employees would consider leaving if flexible working was restricted. I was really, again, surprised. Over 1 million UK workers have changed jobs due to lack of flexibility recently.
Yeah, and it doesn't stack up, does it, with a lot of the headlines that we're seeing with big corporates demanding, back to the office.
Yeah,
it seems a bit of a mismatch with employee desires and needs.
Yeah, I think there's a lot of sector specificness there, and we're seeing it in different sectors have got different rules. But I think great tech leaders know that work's about productivity over presence. I think 85% of tech and product roles are hybrid or fully remote now. And for roles that need an on-site presence, I've actually seen discussions about on-site premiums, i.e., you need to pay to come to the office.
Yeah.
So,
but it feels like I'd want to be paid to go to an office every day and strap hang on the tube. I can understand that.
Yeah, exactly. But it goes a bit wider than that as well. I mean, we've talked for years about personalization, but I think we're now really starting to do that real personalization and flexibility and choice. And flex benefits aren't new. We've been talking about them for 30 years or even longer, but adoption's been quite slow. 20 years ago, I think maybe 15-20% of UK employers offered like formal flex plans. Now I think it's more than 53% of employees cite benefits as the top reason for choosing a new job, and that's just second now just the salary. So that flex is really important.
Absolutely, it's definitely something that we're talking to lots of clients about. What about equity though? Because tech and equity have traditionally gone hand in hand.
Yeah, that's still true, but we are starting to see a bit of a change. We see the sort of bellwethers over in the US, so those big tech companies that we see and we talk about, they really start to set the sort of the market practice, and equity starting to go a bit more selective, starting to get reserved now for sort of more senior or high performing or just critical roles. So it used to be that everybody got equity when you joined a tech company, but it's not always automatic anymore. All the listed companies I've worked for recently, though, RSUs, so restricted stock units, are really commonly used. But you'd also see ISOs, so incentive stock units, really common in startups, which is give employees a chance to purchase shares at a set strike price at some point. But I don't think it's the silver bullet for that we're trying to solve. I think it was great for a time, but remember, it's never liquid in its first 12 months. Normally you have a kind of a minimum of a 12-month vesting period for these things, and it's worthless if you leave with unvested stock. And tech businesses, they're a bit volatile from a share
Mhm.
price point of view, has a real huge impact on your cash there. We know that the tech sector is more volatile than the broader UK market, but all UK stock is less volatile than what we're seeing in the US high growth tech sector. But it's long term. They vest sometimes annually. Some companies do vest them quarterly, so you get the option to sell some shares every 3 months or so. But they're still really, really volatile. Last year, really scary stat, the UK FTSE 250 value was down 30% in the tech sector.
It's
And like
huge.
one of our UK-based largest FTSE 100 tech companies, its 52-week share price, when you look at the highest to lowest, at one point it was 13.35 a share, and then it was 7.71. So over £5.50 difference between
Wow.
point to point. So you happily go in, and there's your RSU award of £45,000. It could just be worth £19,000 less just because the lower share price. So like 26%, sorry, 26k, sorry, even so more than 50% of your value of your reward has gone down, and it's no longer guaranteed. It's quite high stakes in
And
places.
it's not in your gift, is it? It's out of your control. Not like a bonus where generally there's something that you can actively do.
Yeah, and if your package drops that much, motivation probably starts to suffer. People, people feel that their comps has been unfairly slashed by market forces, not their own performance.
Absolutely. So would your message be then that equity still matters, but it's no longer the automatic answer that people thought it was?
Yeah, I think so. And it depends on your overall reward package as well. And it's really important that we get those principles right, because if equity is too dominant in the overall package, the volatility in share price really creates a problem. And I had that in one company that I joined, where it was base salary and equity, and the share price fell so dramatically, and we were having to issue real critical talent awards out to retain people. The worst thing as a leader to hear is someone telling you that £15,000 worth of shares is now only worth £9,000. It's kind of like, ouch.
So is it still common, do you think, for tech companies to award equity?
Yeah, I mean, it's still common, but we're seeing a shift. Startups are cutting equity payouts. We're still seeing awards for AI companies and AI talent, but I think it's becoming more and more normal to look at base pay bonus and equity at more senior levels. I think it's because it's just not sustainable. We've got burn rates. How many shares can you give away? UK listed companies, we talk about dilution considerations. So the number of shares that companies have got is limited. So like everything, you've got a finite pool, and you've got to choose where you're going to put that money. So new hires are definitely still being offered equity. California and New York companies are issuing out big new joiner grants, but they're not being topped up. You used to get these refreshes or some sort of evergreen awards where, so say 25% of your award vested, you'd be given another 25% to kind of keep your level of equity whole throughout the entire time. And Sequoia, who administer hundreds of US tech clients' benefits plans, they've seen about 40% of their clients stop those refresh grants.
Wow.
So it's not feeding through to surveys yet, but you can start to read between the lines, and you can see that equity stop being probably the centerpiece of a lot of these comp plans.
Sure. Okay, so if you were advising a tech employee today, based on your experience as a raw director in the sector, what would be your headline advice?
Yeah, I think agree your principles before you start reacting to individual pay demands. Think about what is it my elements of pay are here to do, and what are they driving, and put in a mechanism to test that they are doing what you set them up to do. Be really clear. Are you going to follow the market, or are you going to hold the line for internal equity? Peer comparisons across your teams. I think thirdly, I'd say just don't rely on one element to solve everything.
Actually, then the answer is a joined up strategy, isn't it? Not just a bigger salary offer. And again, I think that's actually true across every sector, but perhaps the bigger numbers that are involved in the tech sector mean it's been more common here.
Yeah, exactly that. And I think, just think about the whole package. It's always been about pay. It's always about bonus. Increasingly now more about flexibility, other benefits. Development is still huge, and where appropriate, think about equity. But the best solutions out there are the ones that always balance competitiveness and sustainability.
Yeah, that's a really helpful way to frame it, actually. So it's not about being the highest payer in every case, because you can't be top of the market and everything, can you? But about being thoughtful, consistent, and credible.
Yeah, and that credibility really matters. So it's got to look and feel like you're doing the right thing for the people that work for you, and it's the right thing for the business. I think if your leadership teams and your hiring managers really understand that reward logic, they're so much better equipped to make decisions to support the business and that employee experience.
Yeah, brilliant, Richard. Thank you. That's a really clear picture of the challenges facing tech employers and what they really need to think about next.
Yeah, and thanks, Victoria. Great to be here. And you run a forum for this sector, don't you?
We do indeed. We have a specific forum for the tech sector. So if anyone listening is HR or award in the sector, or actually has a large tech population in another sector, then please do reach out to me, victoria@rewardheads.co.uk, and we'll invite you in. Thanks for listening. Thanks for listening to Getting Our Reward Heads Together, brought to you by Reward Heads. As I said at the start, we're a boutique reward consultancy working with organisations across the UK and beyond, really, to help HR and reward leaders design fair, engaging and effective reward frameworks and solutions, from pay and benefits to recognition and governance and things like equity that Richard's been talking about. Every solution we create is bespoke, built around each client's unique goals and challenges. And we also offer coaching, resourcing, and the trusted forums we were just talking about to keep you connected to our latest reward trends. So if we can support your reward journey, we'd love to hear from you. And do please subscribe to hear future episodes. You can reach out to us on rewardsolutions@rewardheads.co.uk if we can help. Thanks for listening to Getting Our Reward Heads Together, brought to you by Reward Heads. We're a boutique reward consultancy working with organisations across the UK and beyond. Our mission is to help HR and reward leaders design fair, engaging and effective reward frameworks and solutions, from pay and benefits to recognition and governance. Every solution we create is bespoke, built around each client's unique goals and challenges. We also offer coaching, resourcing, and trusted forums to keep you connected to the latest reward trends. If we can support your reward journey, we'd love to hear from you.